There's a big change in the autumn budget 2025 discussing Class 2 voluntary contributions. Now, in the past, if you had previously worked in the UK for 3 consecutive years, whether you were a UK national or not, you could then still top up your UK state pension from abroad, and if you were employed, you could do that via Class 2 contributions. If you're unemployed, it was via Class 3, and the big difference between both of these is how much it costs per week to make these contributions. So for Class 2, it's £3.45, and for Class 3 it's £17.75. So you can see Class 3 is 5 times more expensive than Class 2. So imagine you've gone to the UK for 3 years, you've worked there, you're not even from the UK, you could then live outside of the country and still top that up until you received a full state pension, which is 35 years. And it will cost you only £180 to do so. I always thought this was a bit of a loophole. I did do a video a few weeks ago discussing how it is probably a bit too good to be true, and surprise, surprise, this has been closed down. It probably is the right move because it is just taking money out of the UK system, and what you have to do now is pay Class 3 contributions, which adds up to just over £900. So the big question is it worth doing this? If you break this down in simple terms, so let's say, for example, state pension age is 67 currently. Okay, it is going to go up, but it's based on average life expectancy, and you're going to have to pay just over £900 to get 1 year of contribution. The way the UK state pension works, it's based on a credit system of the number of years that you've got. It's not based on how much money you've earned. So for a full UK state pension, it's 35 years of contributions, and this is going to give you £12,000 income per year. So if you take 12,000, divide that by 35, this gives you roughly £340 per annum. So this means you are paying just over £900 to get about £340 per annum in retirement. So you've only got to live 2.5 years to get your money back, and then after that, every single year of contribution is going to be free. This, of course, is very different to only paying £180, where you only had to live 6 months into state pension age to reap the benefits. But another way of looking at this is, what is the alternative? Could it be best to save this money elsewhere? Now, if you are mid 60s to 70, a safe withdrawal rate to make sure your money lasts up until you pass away is roughly 4%. So if you take £340 and you divide that by 4%, this gives you £8,500. And the reason I've done that is because 4% of £8,500 is £340. So if you wanted to get this income based on assets, you would have to have saved £8,500. And instead, all you're having to do is make a contribution of just over £900 to get the same outcome. It is somewhat different because if you've got that £8,500 on death, these assets can be passed to someone else, whereas the state pension can't. And this is where, of course, inheritance tax planning is important. So if you are married, for example, you could pass those assets between you and your spouse without an inheritance tax, and inheritance tax falls on second death. But generally speaking, it's difficult to beat this because you're almost having to save 10 times the amount to get that income in retirement, which isn't guaranteed. Whereas the state pension has the triple lock, which means it is going to go up by inflation. The only thing you need to think of, though, is where are you going to retire? Because the state pension goes up by the triple lock in deferment, which means just you haven't reached state pension age yet. But if you are now receiving the state pension and you're living outside of the EEA and a few other countries, then it will not go up by inflation. So if that is the scenario, it's a bit of a different story. But if you're only going to be living, and the average life expectancy is about 15 years past the state pension age right now, you need to look at what impact inflation is going to have over that given time. If you do live to 100 years old or whatever, then of course it's not going to go up by inflation, but you're getting these contributions every single year anyway, and the contribution that you made was in the year you made that contribution. Yes, it's probably a bit of a tough pill to swallow if you hadn't done so yet, because what they had done is they reduced the number of years that you could backdate to 6 years, and now you're going to have to pay 5 times the amount of money to do so. So again, I think it was a good thing that they did this, because it was definitely too good to be true, and the option now is not as beneficial. The one other change as well is you now need 10 consecutive tax years, or have been in the UK for 10 consecutive years before moving abroad, whereas in the past it was only 3 years. So you need to make sure that you qualify for this to be able to now top up the state pension. Again, I think this is also a good change, because just having lived in the UK for 3 years is not a very long time, whereas 10 years is quite a big part of someone's working life. So all in all, I think this is probably a positive for the UK, and it's not a positive for people that don't meet the requirements, but I think if you're just looking at it from a country level, I think it probably was the right thing to do. So if you do want to follow me for more information on topics like this, please hit the subscribe button. I do a video every Thursday discussing different topics surrounding UK expats, retirement planning, and US expats as well.